And when we talk about this with investors, they honestly, they have the blinders on and they don't acknowledge or understand what's going on in the marketplace.
Hello, everyone. Welcome to the program. I'm Stephanie Stanton. It is so great to have you with us. Please join ETF Guide's community by hitting the subscribe button, and don't forget to post your comments. We always enjoy hearing from you. Well, growth investing once upon a time meant finding companies with real earnings and durable margins. But in today's market, growth investing has been reduced to profitless companies with speculative hype. At the same time, income investors are navigating a rate environment that is punishing duration and rewarding credit discipline, if you know where to look. And that is where Advisors Asset Management steps in. Their ETF lineup spans everything from low duration preferreds to quality growth strategies, each sub-advised by specialists with deep domain expertise. Well, here to tell us more about this is Lance McGray, Managing Director and Head of ETF Product at Advisors Asset Management. Lance, it is so great to see you again.
Stephanie, it's always great joining you.
So let's begin with the AAM Todd International Intrinsic Value ETF, and your ticker there is TIIV. It was recently added to AAM's ETF lineup, so congratulations on that. The fund emphasizes bottom-up fundamental analysis with multi-factor ranking across international stocks. Why should investors be looking abroad, and more specifically, what makes Todd's intrinsic value approach so unique?
Thank you. And, we are awfully excited to have this ETF on our platform. As you mentioned, it has been a busy year for AAM ETFs. We've had a number of launches. This is just another example of how AAM continues to strive to offer the best possible solutions we can to our investors, whether it's rules-based or active, whether it's equity, whether it's fixed income, whether it's domestic, or it's international. And this is a product that we've been working on for quite some time. And before I dive into who Todd is and what their intrinsic value strategy is, because obviously that's very important to the strategy, I think we need to sort of first talk about why investors need international equity exposure right now. And I will admit, going back for the last few decades, if there was any way to put somebody to sleep when you're talking about investments, it's probably talking about international equity investing. The fact of the matter is, given the strong bull market that the U.S. equity market has experienced over the last few years, international equities have lagged. The good news is times are changing. And while U.S. growth stocks and the major broad-based indices that are really growth-oriented have been performing exceptionally well, it's not the only place that's seeing success. In fact, if you look at the ACWI ex-US index on a year-to-date basis going through October 31st, it's up nearly 29%. And that's compared to the S&P 500, which is up 17.5%. So again, very attractive returns. Not only is it really strong on the returns front, that is the international equity space ex-US, it's doing so with less volatility and lower drawdowns. And when we talk about this with investors, they honestly, they have the blinders on and they don't acknowledge or understand what's going on in the marketplace. And when you mention facts like, other major broad-based equity indices, like in Japan, Germany, UK, France, Italy, Brazil, all of their major broad-based indices are at all-time highs. And even the Chinese and Hong Kong indices are pretty much very close to their all-time highs within the last 4 years. So there is a tremendous opportunity out there, given what has gone on in the U.S. equity space. Unfortunately, there's a huge recency bias in terms of returns, but also home biasy in terms of investing in only domestic equities. And we think, geopolitical concerns are easing, growth is accelerating, and we would argue that we are just in the beginning phases of a real secular change in the international equity market. So that's something, just holistically, when we talk to investors, why should you be concerned with international equities? Yes, it's diversification, But the fact of the matter is, over the last year, performance has been exceptionally strong. Changing gears, let's talk about TIIV. Todd Asset Management is the sub-advisor on this actively managed strategy. For those who are not familiar with Todd Asset Management, they were founded in 1998. They're located in Louisville, Kentucky. And quite honestly, their motto is very simple: intrinsic value all day, every day. And their multi-factor model blends, I would say, three specific areas of investment disciplines: one, valuations; two, fundamentals; and three, market recognition, to help identify the most attractive targets or prospects in terms of stocks in the international arena. One of the reasons why we've worked with Todd for many years is because they have a tremendous track record. As I mentioned, this firm's been around for 35 years. The average investment tenure on their investment team is over 35 years. And the truth of the matter is, the underlying strategy that TIIV implements has been live for decades, and the performance has been exceptionally strong in the SMA wrapper. In fact, if you're interested in seeing historical performance, you can go to the TIIV offering documents, and we have SMA performance. But the fact of the matter is, the SMA has outperformed year-to-date, 3-year, 5-year, 7-year, 10-year, almost every time frame. So we're super excited about this product. We're super excited to get Todd out there, let everybody know about how their expertise in the international space, how they've been performing over the years, and just bring this product to retail investors.
Let's shift over to fixed income. One of the hallmarks of AAM's ETF lineup is the disciplined focus on helping investors achieve resilient income. The recently launched AAM Crescent CLO ETF, and your ticker there is CLOC. This hits an area of the fixed income market that many income investors might be missing. Can you explain?
Yeah, absolutely. One of the areas, and you sort of alluded to it already, is at the heart of AAM, at the DNA within AAM, is really income investing. Whether it's dividends on equities or coupons in fixed income, we're really focused, and we actually have a resilient income ETF lineup, which CLOC is part of our newest edition. And this is an area, the CLO market, the collateralized loan obligations CLO market. We've been keeping an eye on this space for quite some time. It's roughly a $1 to $1.5 trillion market, which otherwise, up until recently, I'd say within the last 4 or 5 years, really hasn't been accessible for retail investors. And over the last 4 or 5 years, we've seen nearly $40 billion of assets come into CLO ETFs. And we're seeing an increased appetite for not only institutional investors, but retail investors dabbling in CLO ETFs. And what we've done with CLO is we realize that the CLO market is quite complex, right? At the end of the day, investors are drawn to the CLO market mainly because of the yield pickup. It's not uncommon to get 100, 200 basis points pickup in the investment grade arena over similar corporate bonds because of the complexity of CLOs. And that yield pickup has really been beneficial to investors. And we'll get to this in a little bit, but we think it's going to be exceptionally beneficial as interest rates continue to come down. Investors are faced with very, very hard challenges in terms of, unfortunately, you can't sit on the sidelines and collect 4% in their money market funds anymore. If interest rates can, obviously we had a rate cut in October. If we have another in December, now is the time to get off your cash, as we say here at AAM, and explore areas of the market like the CLO market or low duration income strategies to help facilitate that need for income. Speaking of CLOC, we are, again, part of our business model here at AAM is partnering with institutional boutique asset managers that are very good at what they do. And that is no different than what we have here with Crescent Capital. Crescent is I believe they are up around $48 billion in assets under management. They focus on credit strategies. And in fact, they issued the first CLO back in 1993. So again, we have a portfolio manager that is very well known in the space, not only on the issuer side, but on the manager side as well. We're bringing that to market. One of the true differentiation aspects of CLOC is that in the world of CLO ETFs, they're generally either going to be AAA products or BBB products. What we are doing with CLOC and Crescent is doing as the sub-advisor is truly allowing investors to get the full spectrum of investment grade CLOs. And that's something that I think is going to be really, really a real differentiating factor of CLOC versus the other 15 or 20 CLO ETFs that are in the marketplace.
Yeah, definitely some strong partnerships there. And speaking of strength, the AAM Transformers ETF, and your ticker there is TRFM, just earned a five-star Morningstar rating, outperforming its category by a wide margin. So congrats on that. What aspect of the fund's underlying strategy do you believe is driving this sustained alpha in 2025?
Yeah, Transformers has for those that are looking for growth strategies, again, we focus mainly here at AAM on income generating solutions, but we know how important it is to have growth strategies as well, and the role they play in a diverse asset allocation model. And we're awfully excited to talk about Transformers and the fact that, as you alluded to, just a few days ago, it was after 3 years of a track record, live performance has been awarded a 5-star rating by Morningstar, and the performance has been exceptional. I would say through 1031, TRFM is up nearly 34% year to date, and more impressively, it's returned over 31% on an annualized basis over the last 3 years. Now, you may be saying, okay, well, most likely you are capturing that alpha through Mag 7 exposure, right? Many large cap growth strategies have 40 to 50 or even 60% allocation to the Mag 7 exposure. And I will say that is not the case with Transformers. One of the major talking points around TRFM is the fact that it does not have that much Mag 7 exposure. In fact, it's right around 6%. There are over 200 holdings in Transformers, and that's what makes the performance, quite honestly, astounding, is that we are able to return that without having a tremendous amount of Mag 7 exposure. So the question becomes is, how does TRFM achieve that? I will start off by saying TRFM is a rules-based strategy. Its underlying index is the Pence Transformers Index. And again, this is an index that really focuses on R&D. It focuses on CapEx and sales growth. And in doing so, the goal of TRFM is to identify those big or brilliant companies that are transforming the world around us. And we say big or brilliant because if you're big, you are generally spending a lot of money on R&D and coming up with something exceptional. If you're brilliant, you have a very good concept or a product, and then you get bigger and bigger and bigger. And what we are trying to do through our rules-based index is trying to capture those arenas. And luckily, we've been able to do that. The performance has been fantastic. And lastly, I will say this. Transformers is not a domestic-only strategy. If you're invested in S&P 500 or Qs, you are essentially omitting a large arena, international equities, that provide a lot of growth opportunity. In fact, 63% of R&D spend comes domestically. That means almost 40% of the R&D spent comes outside of the United States of America. And Transformers allocates 25% exposure to international equities as well. And that's been a huge talking point for us as well.
Turning to the AAM Low Duration Preferred and Income Securities ETF, and your ticker here is PFLD. This has been a stalwart in your ETF lineup. Beyond minimizing duration risk, PFLD has other important features that separate it from just plain old vanilla ETFs that are tied to preferred securities. Can you explain that?
Yes, and as you said, PFLD has, is our first product that got up over $500 million. It's been a very good story for us to tell. It's very unique. It is the first and only low duration preferred product in the marketplace currently, and for that reason, it appeals to investors because it really does help solve a problem that preferred investors face, and that's risk mitigation while also maintaining high levels of income. Not only high levels of income, but tax-efficient income as well. As you mentioned, PFLD does focus on low duration, so duration mitigation is obviously at the front of PFLD. But I think one area that is often overlooked as well is how we look to mitigate call risk as well. So while we remove securities that have an effective duration over 5 years to really hone in on the interest rate sensitivity of the portfolio, PFLD's underlying index also removes securities that are trading north of 105% of face value. That call screen right there is very, very valuable in interest rate environments that we're experiencing today. As interest rates come down, these preferred securities are going to be more frequently called. And by doing this, we have the ability to minimize our exposure to those securities that are going to be called. The other major differentiator for PFLD versus many of our peers, specifically the legacy preferred ETFs out in the marketplace, is that PFLD actually includes $1,000 par OTC preferred securities. And why this is unique is because if we go back maybe 7 to 10 years ago, the $25 exchange listed retail preferreds really dominated the marketplace in terms of the preferred assets in the marketplace. Fast forward to today, nearly 70% of the preferred stock market is in these OTC preferred securities. Many of our peers do not incorporate these. It is more problematic on operations and trading and everything, but we are awfully proud to include not only $1,000 par preferred securities, but also $25 exchange listed preferreds in PFLD as well. And that really does help, obviously increase diversification, more holdings, more diversification, but it allows us to provide what we think is really an evergreen preferred product in no matter what interest rate environment we are. We think we can provide, through PFLD, the benefits of the asset class: high yield, tax efficiency, diversification, and upside capital appreciation as well.
Okay, Lance, we have a final question before you leave. Tax loss harvesting is a powerful ETF strategy. It can help investors to reduce the tax bite and maybe even get rid of underperforming investments. How might advisors and investors leverage AAM's ETFs with a tax loss harvesting strategy?
Well, Stephanie, first off, full disclosure, I am not a tax expert. Obviously, your listeners and viewers should seek out the expertise of professionals to answer that question. But what I will say is this is a conversation that comes up quite a bit as we talk to financial advisors. Tax loss harvesting is something that many financial advisors, many retail investors utilize going into year end. Unfortunately, in 2025, with equity markets being very, very strong, the opportunity to realize losses and carry forward and change your portfolios are quite minimal. But what I will say is what we've seen recently, and there was a Schwab Asset Management report that recently came out, and it alluded to the idea that with equity markets being up, many mutual fund investors that are anticipating capital gains taxes and later on in 2025, they're using this as an opportunity to essentially sell out of mutual funds, realize those gains, and then migrate into an ETF, which happens to be more tax efficient from the capital gains perspective, mainly because of the use of custom in-kinds creates and redeems. So again, while we're seeing tax loss harvesting happen, the opportunity to do so in this environment is minimal. But that's not stopping investors from essentially selling less tax beneficial wrappers and using that to deploy into, the ETF wrapper that, with over 4,000 ETFs, no matter what you're invested in a mutual fund, generally speaking, there's probably something that's very comparable in the world of ETFs.
All right, we will leave it right there. Lance, thank you so much for stopping by. It's great to see you.
Stephanie, it's always great. Thank you so much.
To learn more about the ETF strategies at Advisors Asset Management, be sure to visit aamlive.com. The link is posted in the description section below. Don't forget to hit the subscribe button and the comment section below. I'm Stephanie Stanton with ETF Guide. Thank you so much for watching.